Welcome to Book Mint, the channel where we distill the essence of powerful knowledge into easily digestible insights. Today, we're diving deep into the world of investing with a timeless classic, The 5 Rules for Successful Stock Investing by Pat Dorsey. Whether you're a seasoned investor or just starting your journey, Dorsey's methodical approach, rooted in fundamental analysis and a clear understanding of business economics, offers invaluable lessons. So sit back, relax, and let's unlock the secrets to building lasting wealth in the stock market. Rule number 1: focus on businesses, not stocks. This is perhaps the most fundamental and often overlooked rule. Dorsey stresses that when you buy a stock, you're not just buying a ticker symbol, you're buying a piece of a real business. Therefore, your primary focus should be on understanding that business inside out. What does it do? How does it make money? Who are its customers? What are its competitive advantages? Imagine you're considering buying a local bakery. You wouldn't just look at its daily sales figures. You'd want to understand its recipes, its customer base, the quality of its ingredients, and the reputation of its bakers. The same diligent approach should be applied to public companies. Dorsey encourages investors to think like private business owners, performing thorough due diligence before committing their capital. He advises against getting caught up in market noise, short-term price fluctuations, or macroeconomic predictions. These factors, while seemingly important, often distract from the true determinant of long-term investment success: the underlying health and profitability of the business. A strong business will, over time, reflect its value in its stock price, regardless of temporary market sentiment. To truly understand a business, Dorsey suggests several practical steps. Read annual reports, 10Ks, and quarterly reports, 10Qs. These are treasure troves of information. Don't just skim the executive summary. Delve into the management discussion and analysis, the financial statements, and the footnotes. Pay attention to how management discusses their strategy, their challenges, and their future outlook. A strong understanding of the industry context helps you evaluate the company's competitive position. Identify the business model. How does the company generate revenue and profit? Is it a subscription model, a one-time sales model, an advertising model, or something else? Understanding the revenue drivers is crucial. Look for transparency. Good businesses are generally transparent about their operations, their financials, and their challenges. Be wary of companies that obscure information or make it difficult for investors to understand their core operations. Dorsey illustrates this rule by contrasting it with speculative investing. Speculators might buy a stock because they expect its price to rise in the short term, without necessarily understanding the underlying business. This is akin to gambling. Investors, on the other hand, buy a stock because they believe the business itself is valuable and will grow in value over time. Focusing on businesses, not stocks, anchors your investment decisions in reality. It removes much of the emotional volatility that plagues many investors and replaces it with a calm, analytical approach. This brings us to rule number 2, which is intimately connected to understanding what makes a business truly great. Rule number 2: seek companies with durable competitive advantages. Economic Moat is the cornerstone of Dorsey's investment philosophy, and it's where he really shines, building on the concept popularized by Warren Buffett. An economic moat is a structural feature that allows a business to sustainably earn high returns on capital over a long period, protecting it from competition. Just as a moat protects a castle, an economic moat protects a company's profits. Dorsey identifies 5 primary sources of economic moats. Intangible assets. These include brands, patents, and regulatory licenses. Brands. A strong brand creates customer loyalty and allows a company to charge premium prices. Think of Coca-Cola, Apple, or Nike. People choose these brands not just for their products, but for the trust and perception of quality associated with them. This loyalty makes it difficult for new entrants to compete. Patents. Patents protect a company's intellectual property, granting it exclusive rights to produce or sell a certain product or technology for a period of time. This is particularly crucial in industries like pharmaceuticals and technology. A company with a blockbuster drug protected by patents has a significant advantage until the patent expires. Regulatory licenses. In certain industries, government-issued licenses or approvals act as barriers to entry. Utilities, broadcasting companies, and some financial institutions often benefit from these regulatory protections, limiting competition. Switching costs. These are the costs, monetary or non-monetary, that customers incur when switching from one product or service to another. High switching costs lock in customers. Consider enterprise software. Once a company has invested heavily in integrating a specific software system, for example SAP or Oracle, into its operations, training its employees, and building its processes around it, the cost and disruption of switching to a competitor system can be enormous, even if the competitor offers a slightly better price. Similarly, banks benefit from switching costs. Changing bank accounts, direct debits, and credit cards can be a significant hassle for individuals. Network effect. This occurs when the value of a product or service increases as more people use it. Think of social media platforms like Facebook or LinkedIn, or auction sites like eBay. The more users join, the more valuable the platform becomes for each individual user. It becomes a self-reinforcing cycle that makes it incredibly difficult for new competitors to gain traction. Payment networks like Visa and MasterCard also exhibit strong network effects. Merchants want to accept cards that most customers carry, and customers want cards accepted by most merchants. Cost advantage. A company with a sustainable cost advantage can either undercut competitors' prices while earning similar margins or charge similar prices and earn higher margins. This can come from various sources. Proprietary processes. Highly efficient manufacturing processes or logistics systems that competitors cannot easily replicate. Favorable geographic location. Access to cheaper raw materials or cheaper labor. Scale economies. Larger companies can often produce goods or services at a lower per-unit cost than smaller competitors because they can spread fixed costs over a larger volume. Think of large retailers like Walmart, whose immense buying power gives them significant leverage with suppliers. Efficient scale. This applies to industries where the market is only large enough to support a limited number of competitors, making it unattractive for new entrants. Examples include local utilities, railroads, or niche manufacturing industries where demand is limited. In such cases, the existing players are naturally protected from significant new competition because the pie isn't big enough to support many additional players without drastically reducing everyone's profitability. Dorsey emphasizes that not all competitive advantages are created equal. Some are temporary, while others are truly durable. A great investor learns to distinguish between fleeting advantages and enduring moats. He also warns against mistaking strong management or popular products as moats themselves. While good management and popular products are certainly desirable, they can change or fade. A true moat is structural, embedded in the business model itself.
Identifying these moats requires careful analysis and a deep understanding of the industry dynamics. It's about looking beyond the headlines and understanding why a particular company has been consistently profitable and how it maintains that profitability against competitive pressures. Understanding economic moats is perhaps the most crucial skill an investor can develop. It allows you to identify businesses that are likely to compound wealth over the long term, rather than those whose profits will be eroded by competition. But even a great business at any price isn't a good investment, which leads us to rule number 3. Rule number 3: demand a margin of safety. This rule, famously advocated by Benjamin Graham, is about protecting your capital and ensuring that you're buying a business for less than its intrinsic worth. A margin of safety is the difference between the intrinsic value of a business and the price you pay for its stock. The larger the margin of safety, the lower your risk and the higher your potential return. Dorsey explains that intrinsic value is an estimate of what a business is truly worth, based on its future cash flows. It's not the current market price, which can be influenced by sentiment, speculation, and short-term factors. Estimating intrinsic value is an art as much as a science, requiring careful analysis and making reasonable assumptions about a company's future earnings and growth. Why is a margin of safety so important? Protects against errors in judgment. No valuation is perfect. Even the most diligent investor can make mistakes in their assumptions about a company's future. A margin of safety provides a cushion against these errors. If you buy a business at 60 that you've estimated is worth 100, and your estimate turns out to be slightly optimistic, say it's true worth 80, you're still in a good position. If you bought it at 95, your error would be much more costly. Accounts for unforeseen events. The future is inherently uncertain. Economic downturns, technological disruptions, new competition, or management missteps can all impact a company's performance. A margin of safety helps absorb these shocks, reducing the likelihood of permanent capital loss. Enhances returns. By buying assets for less than their true value, you're essentially getting a discount. Over time, as the market recognizes the true value of the business, the stock price should converge with its intrinsic value, generating superior returns for the investor who bought with a margin of safety. Dorsey acknowledges that calculating intrinsic value is not a precise science. It involves making reasonable assumptions about a company's future growth, profitability, and discount rates. He suggests using conservative assumptions when valuing a company. If a company looks attractive even with conservative estimates, it's a stronger candidate for investment. Methods for estimating intrinsic value often involve discounted cash flow analysis, where future free cash flows are projected and then discounted back to the present. While this can be complex, Dorsey stresses the underlying logic. A business's value comes from the cash it can generate for its owners over its lifetime. He also advises against overpaying for growth. Many investors get excited by high-growth companies and are willing to pay exorbitant prices for them. However, high growth is often difficult to sustain, and if the company fails to meet those lofty expectations, the stock price can fall dramatically. A margin of safety ensures you're not paying for growth that may never materialize. The margin of safety is your best defense against the inherent uncertainties of the market. It disciplines you to be patient and only invest when the odds are stacked in your favor. It's a core tenet of successful value investing and leads us directly into rule number 4.
Rule number 4: don't be afraid to look in the nooks and crannies. This rule encourages investors to think beyond the widely followed large-cap stocks that dominate financial news. While blue-chip companies can certainly be good investments, their popularity often means they are thoroughly analyzed and efficiently priced. True bargains, or companies with unrecognized value, are often found in less trafficked corners of the market. Dorsey suggests that individual investors, precisely because they don't have to manage billions of dollars or chase quarterly benchmarks, have an inherent advantage. They can afford to be patient and look for opportunities that institutional investors might overlook due to size constraints or mandates. Nooks and Crannies can refer to small-cap and mid-cap companies. Smaller companies often receive less analyst coverage, meaning their stock prices might not fully reflect their intrinsic value. If you're willing to do the research, you might uncover a hidden gem with a strong moat and significant growth potential. Companies in unpopular industries. When an entire industry is out of favor due to temporary headwinds or changing trends, good companies within that industry might be unfairly punished. If you can identify a company with a durable moat that is likely to weather the storm, you might be able to buy it at a substantial discount. Companies with complex business models. Businesses that are difficult to understand on the surface might be avoided by many investors. However, if you're willing to put in the effort to unravel their complexities, you might discover an undervalued asset. Spin-offs and divestitures. When a larger company spins off a division, the new independent entity can sometimes be overlooked by the market in its initial stages. These can sometimes unlock significant value as the market begins to understand the spun-off company's true potential. Companies with specific catalysts. Sometimes a company might be undervalued due to a specific temporary issue. Example, a product recall, a lawsuit, a temporary operational hiccup. If the issue is resolvable and doesn't permanently impair the company's moat, it could present a buying opportunity. Dorsey emphasizes that looking in these nooks and crannies doesn't mean investing in risky, unproven ventures. The same rigorous analysis for moats and margin of safety still applies. The difference is the hunting ground. You're looking for the same quality businesses, but in places where fewer eyes are scrutinizing them, increasing the chances of finding mispricing. This approach also encourages independent thinking. Don't just follow the crowd. If everyone is talking about a particular stock, it's likely already priced for perfection. The greatest opportunities often arise when you go against the prevailing sentiment, armed with your own thorough research. This approach empowers individual investors to leverage their unique advantages. It's about being a detective, digging deeper than the average investor, and finding value where others might not be looking. And finally, we arrive at rule number 5, which is all about how you manage your portfolio and your mindset. Rule number 5, know your circle of competence. This final rule, also a favorite of Warren Buffett, is about understanding what you know and, more importantly, what you don't know. Your circle of competence is the area of business or investing in which you have genuine expertise and understanding. Within this circle, you can make informed investment decisions. Outside of it, you're essentially gambling. Dorsey argues that successful investors don't need to be experts in every industry. They just need to be honest about their limitations. If you don't understand how a particular business makes money, or if its industry is too complex or opaque for you to grasp, then simply don't invest in it. There are plenty of great businesses out there that do fall within your circle of competence. How do you define your circle of competence?
Reflect on your knowledge and experience. What industries do you work in? What products or services do you use every day and understand well? What subjects are you naturally curious about and enjoy learning about? Be honest about complexity. If a company's financial statements are overly complex, or if its technology is beyond your comprehension, it's a signal that it might be outside your circle of competence. Avoid fads and hype. Often, new technologies or industries generate tremendous hype, but their underlying business models can be difficult to assess. Resist the urge to jump in simply because everyone else is. Dorsey explains that staying within your circle of competence has several benefits. It reduces risk. By investing only in businesses you understand, you significantly reduce the risk of making uninformed decisions and losing capital. You're less likely to be surprised by unexpected developments because you've already considered the potential pitfalls. It improves decision-making. When you deeply understand a business and its industry, you can more accurately assess its moat, estimate its intrinsic value, and identify potential risks and opportunities. It fosters patience. You won't feel pressured to invest in every opportunity that comes along. You can patiently wait for opportunities that fit squarely within your expertise. It builds conviction. Your understanding of a business will give you the conviction to hold on to it during market downturns rather than panic selling. You know why you own it. He emphasizes that your circle of competence is not fixed. It can expand over time as you learn and gain more experience. However, the key is to expand it consciously and deliberately rather than haphazardly. Knowing your circle of competence is an act of intellectual honesty and humility. It protects you from chasing fads, making speculative bets, and ultimately losing money. It's the disciplined approach that underpins all successful long-term investing. So, there you have it, Pat Dorsey's 5 rules for successful stock investing. Let's briefly recap. Focus on businesses, not stocks. Seek companies with durable competitive advantages, economic moats. Demand a margin of safety. Buy at a discount to intrinsic value. Don't be afraid to look in the nooks and crannies. Find value where others aren't looking. Know your circle of competence. Invest only in what you understand. Dorsey's book is a powerful reminder that investing doesn't have to be complicated. It's about fundamental analysis, common sense, and a long-term perspective. He provides practical tools and clear explanations, making value investing accessible to everyone. For anyone serious about building wealth through the stock market, the 5 Rules for Successful Stock Investing is an essential read. It equips you with the mindset and the framework to become a more discerning, patient, and ultimately more successful investor. Thank you for joining us on Vibe Audiobook. We hope this summary inspires you to delve deeper into these timeless principles. Until next time, happy investing!